Hello, welcome to Gold DNA. This is Advanced Option Greek course presented to you by Gold DNA, where you will learn about option Greeks, their advanced concepts, and how they are used in handling trades and risk management. So let's begin. So first of all, disclaimer, a very important part. So all the materials presented in this representation in this course are for your information and education purpose only. Kindly do note that we are not any registered advisor with any market regulatory authority, and all the advices, knowledge, information or education provided here cannot be used for any trading purposes. Kindly do consult your financial advisor before entering into a transaction. Thank you. So what you people learn from this course? How will you benefit from this course? In this course you will learn how the professional option traders which are sitting in the market, they are generally market makers or proprietary option traders, how they use Greeks, how they identify Greeks, how they manage their position according to the Greeks, how the Greeks changes in relation to each other. You know, there are majorly four different Greeks: delta, gamma, vega, theta. Everyone knows what are they, but very little people know how they interact with each other, how they are related with each other, and how they changes with respect to the time, or how it changes with respect to the changes condition of the market. So you will learn that here. Because this is an advanced course, we will just touch upon the basic part of Greeks, and then we will move on to the advanced stages. So these are some benefits. You will learn how the professional option traders use Greeks, how the Greeks works in different conditions, how to manage your risk by managing your Greeks. In options, everything is managed by Greeks. If you can't manage your Greeks, your trade will go out of hand very soon. Next. So what is this course suitable for? You know, this course is definitely an advanced course. This course is only for those people who have a basic knowledge about options, the calls, the puts, the strike prices, the out of the money option, the in the money option, etc., the implied volatility, etc. So if you have a basic knowledge about option Greeks, then this course is for you. If you are just a beginner in the options, or you are just want to learn about options, what are calls, what are puts, then this course is not for you, because we will just touch upon the basics of Greeks and then we will move on to the advanced stages. We are assuming here that you have the knowledge of options, because we will not discuss the knowledge of options here. So if you want to learn deeply about Greeks, then this course is for you. So next. So what are Greeks? So as I said earlier, we will just touch upon the basic part a little bit in order to refresh our minds. What are Greeks? Simply, Greeks of option measure how the options will earn or rule or lose with respect to changes in the different factors which affects option price. So if you know that option price are generally derived from Black-Scholes model. Black-Scholes model take 5 inputs in order to derive an option theoretical value. Basically, there are two values of option: a theoretical value which is derived from the formulas, a market value which is derived from the order book, the bid and ask. What are the bid and ask? So that is the market price of the option, and there is also a theoretical price of option which is derived from the Black-Scholes model. So the factors which affect, so how one can derive the option price? If you put the underlying price, strike price, volatility, I have written this there: underlying value, strike price, volatility, time to expire, risk-free rate, and dividend. If you put all these factors into the Black-Scholes formula, it will fetch out the theoretical value of options. So Greeks basically measures if any of these factor changes, How the option price will change? If I just I bought a call option and the underlying just shoots up, so the when the underlying value changes, how much the option price will change, it will be told by the Greeks. If I change the volatility of the option, if the market just come crashing and the implied volatility is rising in the market, so how will the Greeks will change? How will the option price will change? This is told to us by the Greeks. Greeks measures if these factors are changes, how will the option price will change. We will just go to an example. Uh, this is just a touch upon what are the Greeks and how they affect the option prices. So how they are calculated, one can ask how these option Greeks are calculated. Basically, we will do not indulge in the mathematics. In all the modern option trading software, these Greeks are auto calculated and available to us. So we don't need to, boil down into the mathematics of how they are calculated to the integration to the derivatives. We all don't need to do that. We just need to discuss what are they and how they react with different to different market situations. So next, different Greeks. So all of you might know that there are majorly 5 Greeks: delta, gamma, theta, vega and rho. So what is delta? Delta measures how much the option price will change with respect to change in the underlying price. This is the simple one. If you buy a call option, you are waiting for it to the stock or market to go up. So if the market do go up, how will the option price will earn or lose? This is told by delta. The second one, the gamma. So basically, if delta calculates how much the option will earn when the market goes up or down, the gamma will calculate how will the delta will change. The delta is also not stable. If I bought an option and its delta is suppose 0.50 per dollar change in the underlying value, the delta will not stay stable. We will look into the coming examples that how it will change, but just to touch upon delta, for that matter, all the Greeks are not stable. They will change with respect to change in the market. So if I bought a call option and the market moves up, the delta of that option will not remain 0.50. It will change. It will increase or decrease by a certain amount. So that amount, that how much this delta will be changed, is calculated by gamma. Next, we will dive into the details of these Greeks little bit later on. So theta. Theta is simple one. Theta measures how options will lose value over time till expiry. So every one of you must know that whenever we buy options, options value will decrease day by day, day by day, day by day till the expiry, because the out of the money option have to become zero at the date of expiry. So the daily decay in the options is called theta. Next is vega. Vega measures how the options value will change with respect to implied volatility. So vega, professional option traders generally maintain their main focus on the vega, because implied volatility is just like the dark horse of the options. It is just like a hidden part in options which generally retail traders do not look upon. Vega is such an important measure that it can IV is such a major important factor in options that it will generally blow up all the other Greeks. So we will look at the vega also, but I'm telling you that this implied volatility is very important factor in options. So next is rho. It measures how much the option value will change due to change in rate of interest. So rho is generally not a matter to the option trader, because option traders are generally remain focused toward the short term options, because there are traders who focus ultra long term option that expires in 6 months, 12 months. In such options, the change in rate of interest matters, but in short term option, weekly option, monthly option, it doesn't matter that much. So we will don't dive into the row. We will just look at the all the above four option, delta, gamma, theta, vega, in detail. So first one, what is delta? As stated earlier, delta measures how much the option price will change with respect to change in the price of underlying. So now the time for example, if I buy a call option of strike price of 100 and the stock is trading at $100 for $2. So I am looking at a stock which is trading at $100 and I am thinking that this stock will go up. This stock will just shoot up. So why not buy some call option? So I bought a at the money call option of $100 by paying $2 for each option. And I look at the software and it's showing that the delta of such option is 0.50. So what does it 0.50 mean? If the stock moves up to $106, so there is $6 change in the option, then call price will move up by $3. So how it is calculated? The delta is 50. Delta calculates the how much the option price will change with respect to $1 change in the underlying value. So if the underlying moves $6 and the delta is 0.50, then for each dollar it is 0.50. For $6 it will be $3. So what is the new option price? The new option price is $2, the original value, increased by $3. So the new option price will be $5. So delta calculates, so simply put, delta calculates what is the impact on option price with a dollar change in the value of the underlying. For example, now take an example of put option. The stock is trading at $100. I think that this share is going to tank. It's going to just going down and down. So the put option is currently priced at $2.50 with a delta of 0.50. So mind it, in both examples I have purchased the at the money option, and at the money option generally have a delta of near 0.50. So a put option of $100 strike price purchased at $2.50 with a delta of 0.50. What will happen if the stock moves to $94? The delta calculates for a dollar change. If the stock was $6, then how much the option price will change? The put price will move up by $3, $6 into 0.50, and the new option price will be 5.50. Original price of 2.50 and $3 the change in option price. So I'm making good bucks here. 2.50, a thing purchased at 2.50 is now trading at 5.50. So these are hypothetical example to show you the effect of delta. But remember that delta does not work in isolation. When the market goes up or down, there are other factors which are changing as well. So this is not simple as it is looking in the example. This example assumes that all the other factors are remain constant. But in real life, this is not the case. If the $100 stock goes to $94, its implied volatility will generally go up, and vega will also its impact, and there will also be a time lag. $100 to $94 might move in 10 days, then there might be 10 days of theta as well. There might be gamma as well. If the stock falls suddenly, then the gamma hits its impact also. Then the new delta will not be stable at 0.50. So we'll discuss all these things later on. So this is the basic delta part. So this is just a pictorial example of what we have discussed earlier. I purchased a call option of $100 strike price at $2 per share. How much will I earn if the stock goes to $105? Now all of you might calculate. If you want to predict, this is our goal busy. All the wisdom of old DNA is provided by this wizard. So If you want to predict option value solely due to change in price of stock, then check delta of option as may be provided in option chain. If the delta of such call option, because I'm talking about at the money here, if the delta of such a call option is 0.50 and the stock moves up by $5, then the option price will move by $2.50 and the new option price will be 4.50 to the original price and 2.50 the change in price due to a rise of stock. You will make $250, yes, because generally there are lot of 100 in option market, but this is general. Every market have their own lot system, but I'm taking a general example of 100 shares in a single lot of option. So if my option moves by $2.50 and I purchased one lot, it's equivalent to 100 multiplier. I will make $250 in profits, assuming all the other factors are remaining. This is important line, assuming all the factors are constant. So this is about delta. Now let's move on to the next. So the important part, how the delta behave across strike prices. If you look at the option chain, just like this is just an option chain of Apple, I guess. Yeah, it is Apple. It was trading around $140 when I have just cropped it. So this is the general, this is an option chain. All of you might have looked at hundred of times the option chains. The options are put into different strike prices in vertical order, their open interest, last price, implied volatility, delta beta. So all of you must have looked at the option chain. So how the delta behave across the strike prices. So these are the strike prices. Currently Apple is trading at $144, $142. So how the delta will change with across the strikes. So if you look at these are the call side. The more I go in the money, the more I go in the money, sorry for the disturbance, the more I go in the money, the delta is starting to increase. If you look at the 0.50, 0.59, 0.63, the more I go in the money, the delta will increase. So, and if you look at the put side, the more I go out of the money, because I think all of you have must known how this I am telling in the money, out of the money. So the more out of the money you goes, the option delta will starting to decrease, 0.45, 0.40, 0.36. So general principle, the more you go in the money, the delta will increase. The more you go out of the money, option price, the delta will decrease. So again, back to our sheet. At the money option have delta of around 0.50 or minus 0.50. So at the money option, as I told earlier, have delta around 0.50, but it is around the 0.50. It might be 0.55, 0.56, around the 0.50. As you move forward, delta will start decreasing. As you move out of the money, delta will start decreasing with each strike being more OTM. And reverse is the case of in the money. The more you start ITM, delta will start increasing. Delta can be aptly called as the probability of such option going in the money. This is the rise in my OTM option at decreasing delta, and this is the negative delta. So this is a common sense. Delta is generally referred to as the probability of such option going in the money. So this is the reason why you move further OTM, the delta will start increasing, and the more ITM you go, delta will start decreasing. This is proved through option chain of Apple. You can look at the more ITM I goes, the delta will start increasing. The more out of the money I goes, the delta will start decreasing. So now, how the delta behave across expiries? There are different expiries in options: weekly expiry, monthly expiry. In US stock option or in crypto markets, there are daily expiries as well. S&P expire almost every 2 days, and Bitcoin and Ethereum expiry have almost daily expiries. So how the delta behave across different expiries? So the general rule is the more far is the expiry, the more delta will option have. So as stated in in previous slide, delta is roughly the probability of option going in the money. So the more the far the expiry, the more the probability of such option will going in the money. So as you move further in the time, the delta of such option will tend to increase. If you compare the same strike price option with the expiring in the next week versus the option expiring in the next month, you will find that the far-term option have more delta in comparison to near-term expiry. We will look at the example in the option chain. Remember that more time, the more probability of such option in the money, and hence more time means more delta. So now look at the option chain. So this is the weekly expiry option chain of Apple. If I look at the 140 strike price put, it has delta of 0.40, and if I move to the 1 month expiry, the same strike price put, that is 140, has delta of 0.43. So you can compare easily the increase in strike price. It has strike price, the weekly expiry has delta of 0.40 of the same strike price, and the 1 month expiry has increased delta of same strike price. So this proves the principle that more the time, more the delta, the shorter the time, the less the delta. So next part, how delta behaves with volatility. As I've told you earlier, volatility is just like the dark horse of the option, because its knowledge is very limited to very limited people. Retail traders don't even look at the volatility. So it is important to note how the volatility impacts the option prices. So increasing volatility increase the delta and vice versa. Volatility is the expected movement in stock price in either direction. So this is the definition of volatility. This is the simplest definition of volatility. If the stock is trading at $100 with an implied volatility of 20%, it means that market is expecting that such stock to trade in range of 80 to 120. If we increase the IV to 30%, all of a sudden the range changes to 70 to 130. So volatility means what? Volatility is the expected range of the stock price, which is option market predicting. So if a stock is trading at $100 and its current IV is 20%, then option market is predicting that either that most low it can go to $80 and the highest it can go is $120. So volatility calculates this, that what is the range of this stock. So how the volatility impacts delta? If you look at this example, if the current IV is 20%, and if I increase it to, if I just raise it to 30%, then all of a sudden this range will change. This will go to 70, this will go to 130. So if you just apply the common sense, rising implied volatility increase the range of expected range of stock trading in that range. If the range changes, the range is widened of that stock for that stock, that means the delta will also increase, because there is now more probability of OTM option, the out of the money option, to going in the money. When the IV is 20, the 85, let's say $85 put option might have some probability of going in the money. Suppose let's say 25%. If we suddenly raise the IV to 30%, that $85 put option is now looking a very good chances of going in the money. So increasing IV will increase the delta, and decreasing IV will decrease the delta. So this is the delta part, the first part of our advanced option Greek course. In the next video, we will discuss the impact of the gamma on the option prices. This is the delta part. So thank you for the watching, and please subscribe our page for fresh content, for new content. In the next video, we will discussing the gamma. Thank you.